any industry that relies on trust-based collateral will be consumed by truth-based collateral. And you just think of all the industries that really run on collateral, whether it's bonds, credit, banking, insurance, energy, sovereign finance, real estate, whatever it is, you realize that Bitcoin is just going to start to slowly touch everything and then just take over.
What is money? What is credit? What is risk? And I think thinking about all of these three things in concert are very important, right? There's been this huge push to figure out like, what is money, right? Safety wrote a book about it, the Bitcoin Standard, Sailor Series, What is Money podcast with Robert Breedlove. There's been a lot of focus on this, and people had to learn about what is money, right? Step one, once you have the money, what do you do with the money? Step two, credit. And then part of that is credit and risk. So that's where we're at in this evolution. And that's where this thing needs to go. That's the natural evolution of this entire space. So I asked the guys on the screen today to think about the word credit. Like, what does credit mean to you? Like, how does it impact your day-to-day life today? And what does it look like? Because this entire landscape is likely going to get changed and shift up a little bit. So Adam, I know you've talked a lot about this. You've done a lot of digging into the space. I'm going to start with you, and maybe we'll pass it over to Mike and start to think about it.
Yeah, it's an interesting question, the philosophical aspect of money and valuation itself, right? And right now, I just think that we're watching the credit markets slowly realize that trust itself is a counterparty risk, but the thermodynamics of Bitcoin is not. And I think that the fact of the matter is that Bitcoin is the apex collateral because everything else is literally just a claim on entropy. So if you really think of the implications of this, any industry that relies on trust-based collateral will be consumed by truth-based collateral. And you just think of all the industries that really run on collateral, whether it's bonds, credit, banking, insurance, energy, sovereign finance, real estate, whatever it is, you realize that Bitcoin is just going to start to slowly touch everything and then just take over because it is the least risky asset. And, you know, the classic debate is that Bitcoin is competing against gold, against the dollar. But I think really on a bigger picture, what Bitcoin treasury companies and maybe more specifically strategy have really illuminated is that Bitcoin is competing against kind of what the default architecture of trust is within our civilization. And this is why everyone's brains are being so broken and understanding Bitcoin's relationship to markets is tough because there's so much of that unraveling to do. It's just a lot of deprogramming on a very fundamental level. So if money equals like crystallized time and energy, you know, your effort, your labor, then credit is something like belief in future productivity, and risk is entropy that just leaks through that trust. So I think on a broad scale, I think everyone should think of credit as being civilization's shared hallucination that tomorrow will exist. And I don't know. I just think that this is proven because we all know that fiat credit literally created the illusion of growth through debt expansion. That's the position that we're in. So it's literally proven.
Yeah.
Every single debt-based empire that has been built on borrowed time, you know, and Bitcoin is where time finally collects, and whoever has the most Bitcoin collects the most. So I think it's a very interesting philosophical discussion.
Totally.
But in a nutshell, that's kind of what I think about Bitcoin, credit, money in a nutshell.
Mass solution is an Instaclip. Make it happen.
Instaclip. The clipping team is watching this. Please clip that one. There you go. Please. It really all comes down to trust, right? And so when I think of credit, I think of just seeing credit throughout my life. I go to the restaurant and I use a credit card. I have a mortgage, or somebody gets an auto loan, or you've got these other different types of credit systems that are just really pervasive and in everyday life. Why does that structure exist? That structure exists as a trust system to provide, you know, the ability to interact within society based on like how time, energy, like and money is flowing throughout a society. So really this concept of credit and money is like so incredibly intertwined with like the entire ledger system. You can see how there's a natural transition here into the credit landscape, and Bitcoin's going to work its way in there. Go ahead. Anybody else? Other thoughts? I've got some data information. Grain, hop in there.
Sure. So I think all of us know there's basically three forms of credit that most people are used to. One form of credit is, I mean, you could use a debit card for things, or you can use a credit card. And so you go make a bunch of purchases. You get paid twice a month or once a month or weekly, whatever it is. You make your purchases. If you're responsible, then you pay off the bill in total at the end of a month. That's 1 month credit. You need a way to get to work. Well, what can you do? You could walk to work for 5 years, save $500 a month, and then go buy a car for cash. Or you could buy a reasonable car, put down a reasonable down payment, only walk to work for 2 years, and then buy the car on credit, and then you pay it off while you're driving it for the next 3 or 5 years. That's a midterm credit. And then the longer term credit that Jeff just talked about is a house. You can go live in a tent, and you could do that, save up your money, or live at home until you have enough money, go buy a house for cash. Or you could buy the house on credit, and the collateral is the house itself. And I was thinking about what I said about Saylor. If he only has 15% debt and the rest is equity, he bought a house with 85% down. So he has very little leverage. Most people do the reverse. You put down 20% or less than 20% to go buy the house. So we're all used to this, but sometimes his numbers are just bigger. So I think we all use this every day. I posted a video from Ray Dalio.
Yep, that's in the chat.
Yeah, how the economic machine works. That if you were to go to any I pick on Ivy League all the time, econ professors, none of the econ professors could explain how the economy works in 30 minutes like Ray Dalio's video does. It's got almost 500 million views. It's 11 years old. Watch the video. It explains credit. And the benefit for this is that it makes the economy, because you're buying more cars because you could buy them on credit, that allows more people to work in the factories, and your economy grows. And so in America, we have the FICO, credit reports. Literally, they're called credit reports. And if you have good credit, they let you borrow more money, and then you can get a better car. Now, if you take this the wrong way and you buy things that you cannot afford, then you have problems. And so that becomes a personal responsibility piece. So credit is the bedrock. And in the US, we have these, like I said, credit reports, which allow you to borrow money. And the people that hate credit reports are the people with bad credit.
Yeah. And the amount of credit that you can go get is actually pretty insane. I don't know. I think I've got I used to game the credit card system, right? So you get one, you sign up, you get the points, you do all the things. And that was just a thing in traditional finance. It's like what you did. And at one point, I think I had like $500,000 of credit limit. I'm like, this is insane. And I can't believe I was able to rack all of this up. And it's just a mathematical number of trust based on, the way I've interacted in society. So it's like this construct that exists everywhere. And Mike, to your point, you've got revolving credit, installment credit, open credit, different designs of different credit systems. And there are people that are taking the risk on the other side of that trade, right? So anytime you open a bank account or a credit card, you're the JP Morgan, when I go put in my application, they're taking the credit risk behind the scenes, but they've got all these assets that sit behind it. So if I, default, they're like, all right, it's, they're taking that risk that's built into their entire calculation. And that's why the interest rates change and are associated with it.